probably.
WACC is high.
Yeah, WACC, and so you average basically, it's just weighted average of the two costs of capital. So they have more debt, you weight it toward debt, you take their cost of debt and you weigh it. We'll talk about that later. Anyway, this is their WACC, and that's the rate we use to discount the cash flows. And so we finally have this NPV distributed among shareholders. So you take out some of the cash and you do some accounting MacGyvering over here, and then you divide it by the shares outstanding. There's 99.06 million shares outstanding. Basically, this money is split between them. Well, the money that at least goes to equity is split between these people. So this is all the equity. It's split between these people, and it gives you the share price that we expect. So basic question.
I was going to ask, the D divided by B, is that debt divided by value? I'm just sorry, just asking a small question. On the other side, under WACC calculation,
Yeah.
DV?
DV?
Yeah. What is that?
Oh, I did this via solver, as you can tell by the horrendous amount of decimals on the rate. You can do this a number of ways. In general, people use the current debt outstanding and the current market cap of the company.
So take this debt divided by market cap, that's how you got that number?
No, it will be debt divided by market cap plus debt.
Okay.
It's DV, right? Because they have the market cap only reflects the equity,
Yeah.
and then you have the debt.
Okay.
You normally get debt to equity. What's the equation for converting debt to equity to debt to value?
What's the equation for converting debt to equity? Debt to value. Let's see. Debt. Well, I don't know. You can always just figure this out.
Well,
I never really thought about it. The equation.
I just figured you go from that.
Okay. I just kind of sorted out.
You normally get debt to equity, which is a very different ratio, but you need debt to value for the WACC, and this is the equation you use.
Yeah. And you'll be able to find the value of debt to equity ratios. Okay. And so that's important in calculating the WACC. Someone else will talk about that subject a lot more when they're talking about WACC. Okay. So cash. Okay, you take out cash, take out everything. As I said, you come up with the value that will be given to the shareholders. Because, so the company generates money. Who does that belong to? Shareholders and who else?
Debt holders.
Debt holders. So you take out the part that belongs to debt holders, and you have the part that belongs to shareholders, and you split it that many ways, and you have the price per share. So that gives us a cool estimate of what the price is without looking at the real price. Okay. And then sensitivity analysis. Okay, let me take this one out. So basically, sensitivity analysis, one important one is like growth rate. And somebody asked about how you do this. So let's say growth rate. The current growth rate is what? I said 3%, I think. Let's see, where did I say the growth rate?
No, okay. Second top growth. Revenue growth?
No, I just put in the number 0.03, right? Okay. So anyway, this is how you do this in Excel. Pay attention. You take your final value, right? And you put it down here. And you have this table, and this is where you want your sensitivity analysis. Here you take your actual percent. So 2%. Oh, hold on. I'm going to need to look at. Oh, okay. Let's say for the cost of equity, right? Wait. Okay. So the cost of equity, what do you guys think it'll range between for a stock? How much does the stock generate?
10%?
Yeah, no, it's 10% at lowest, let's say, and 20% at highest. Okay. So we'll take that, drag it across. 20%, right? And so now, these values will need to reflect the stock price if the cost of equity is 10% versus the stock price if it's 20%, and all the ones in the middle. So this is a cool trick you can do in Excel. It's not a trick, but it's just something you're supposed to do. Go to what if analysis, or data tab, what if analysis, data table, and then for row input cell, you put the thing that's changing, this. And there you go. So basically that's saying, and this of course is important to think about, basically, and oh, by the way, to do my cool color thing, really easy, conditional formatting, color scales, color. Yeah, I know, this adds a touch of professionalism to anything you do. Okay, so that's, cost of equity, right? So, you know, the lower your rate is that you're discounting it by, the higher the price will be. So, you know, if you can get 10% in the bank, then this will look a lot better. Whereas if you can get 20% in the bank, then this will look a lot worse. Think about it that way. So, the stock price, of course, will drop as the discount rate increases. And that's, I think, what you need to gather. Questions? Anyone want to see anything cool with this?
What's that whole thing you just did? What's that called? You find the value of different discount rates?
Sensitivity analysis. And I want to see this on everybody's DCFs just because in things you can do this for more than one thing. You know, what else is a variable that I'm assuming? So let's say, you know, I'm assuming a growth rate of let's see, cost of debt. That's what we're doing there. So cost of debt, right? Let's say their bonds are going to need to yield more in the future. So let's go between 1% and 10%. Bonds are, of course, less risky. They have to yield less risky. Why are bonds less risky?
Because they're not residual payments.
That's a financial way of saying that, yeah. So yeah, because they get the dibs on first dibs on the company's capital. All right. Oh, and now, so what do I do here? Anybody want to tell me? I highlight all of this, and what do I do? Go to data. What if analysis? Which one do I press? Data table.
And then get the
Cost of debt. Good. There you go. And so I want to see this like on each one, on each price, just because, you know, Professor Cooney will always ask, oh, why are you assuming this rate for that? You know, that's because that's what Professor Cooney does. And so you can just show on this table and you say, well, you know, like, do whatever you want. Say, you know, you want a 14% rate, that's going to be your price. You want a 6% rate of cost of debt, that's going to be your price. And if you have all of this, people don't need to ask you to fix your model.
Do you usually do this on like cost of debt or cost of equity separately, or you do WAG, or you do free?
You do whatever you think you're making a big assumption about. Anything that you're making a big assumption about, you should do this. I think the most important one is the growth rate. This is not growth rate, by the way. Cost of equity. You can even do it on your beta, I would say, just because beta, people have different opinions on beta. So anything you have a strong opinion on, you should do this. Other questions?
Did you actually send this out long data thing? Just
Okay.
Can you send this as a DCF template?
No, this is a bad template for DCF. I don't want, guys, you guys, this DCF took me like 10 minutes just because I was rushing to do this. And so basically what I did is I estimated the, I said, okay, you know, they've been 17% historically, let's just keep them at 17%. It's not a good way to do that. I just got lucky with the stock doing so well. Okay, other questions?
Conditional formatting is awesome.
Yeah, conditional formatting is awesome. Other questions?
That wasn't a question, that was a statement.
That was a statement. Okay, so you guys now will know how to do CAPM, and I hope you guys have a better understanding of risk and return and finance in general. Next lecture will be on probably WAC or maybe DCFs for both. Okay.
Who's teaching it?
It'll probably be after spring break, just because I don't think we're going to do this next Sunday because no one will be here.
Yeah. No, who's teaching?
Who's teaching it? Probably me, right?
I can do it, doesn't matter.
Okay.
Yeah, me. We're going to do 2 lectures on DCF, so one will probably be Dirk, one will be
No, we'll do DCF, and we'll use the DCF we use for the competition.
That's good. That would be awesome. Yeah, we're going to the Michigan Investments competition. A bunch of cool Ivy League schools and stuff are also going, so we'll be competitive.
But it don't matter.
Huh?
Doesn't matter. We can kick ass.
What is you guys do dividends to forecast the value of the stocks?
Huh?
Why don't you use dividend streams?
Dividend streams? Because not all companies pay dividends. So like
I
Microsoft
mean,
doesn't
for a
pay.
company that does pay dividends.
For a company that does pay dividends.
Is
Well,
that another way?
because
I mean,
they'll also have cash on top of the dividends that they're just storing, and there'll be claims to more than just the dividends.
So, yeah, it's always just the cash flow.
Yeah, so cash flows is the best way because that's just a reflection of what the company will finally give you.
Is dividend included? I mean, dividend should be cash flow, right? I mean,
Dividends? Yes.
are they cash flow?
Yeah, dividends are included in the calculation. I didn't have to worry about CBI paying dividends, luckily. Because they stopped paying dividends after the recession.